And good morning, everyone. I'm Brandy Tish from Refinitive, and welcome to the Ibort Transition Challenges, Developments, and Opportunities webinar. I think everyone should be on mute right now, but at the end we will do some questions, so be prepared for that. So it's only 46 days until the sterling Libor cessation, so we're really excited to present this webinar today, where we'll discuss the latest updates, timelines, and just generally how to move forward and overcome any challenges. So first I will start by introducing our speakers today. So next slide, yeah. So firstly, we have Kedar Desai from Ernst Young's financial services team. Additionally, from the Refinitive side, we've got Alex Hardawa from our fixed income desktop team. And finally, last but not least, we've got Vincenzo Damaze from Refinitive's sales strategy and execution team here at Refinitive. So I think first up is Vincenzo. So over to you.
Yeah, many thanks, Brandy, and again, thanks for having me today. We are indeed approaching, as you anticipated, the first more important deadline of one of the most challenging projects that the financial markets has ever experienced in the last 15-20 years. In less than 45 days, one of the most used set of reference rates, Libor, will come to an end. And considering the ubiquitous nature of Libor and the huge amount of financial products that it underpins and how linked it is to our internal procedures, we all get the sense of how complex this transition has been and is. While the Libor transition project really started several years ago, it is in 2021 that we have seen an important acceleration into the project. On March the 5th this year, the FCA announced the cessation dates for all of the 35 Libor tenors by the end of the year, with the only exception being for a US dollar, where only the 1 week and 2 months will stop and the other will continue until June 2023, with the only objective to allow a smooth runoff and maturing of the contracts linked to that, but with a clear indication from US authorities that no new USD Libor product should be created as of 2022, so by the end of the year. The FCA announcement really accelerated the path, and by March the 5th, as we know, also the ISDA spreads adjustments value became fixed value. And since that date, a series of events, as you can see here below, have taken place across all involved jurisdictions, recommending basically to the so-called risk-free rates first initiative, so SOFR first, SONIA first, which had the objective to drive liquidity on risk-free rates by recommending a switch in the conventions. And also the availability of term SOFR, which came in during the summer after being awaited for a long time. Also on the 29th of September, the FCA published a new consultation paper on the so-called synthetic Libor, with the aim of supporting market players with the so-called tough legacy contracts, denominated in GBP and JPY. We will be covering this topic later on with our slides and with other speakers. And then other initiatives came in, making, as you can see, a pretty busy slide, but also second half of the year, providing market with all the required information to accelerate and complete the transition path. But now let's focus possibly on British pound and US dollar, and I would like to hand over to Kedar. Kedar, the floor is yours.
Thanks, thank you, Vincent. So my name is Kedar Desai. I work as a director in Ernst Young's financial practice and have been implementing the Libor program for over a year with many banks in the UAE and the Middle East, starting with the biggest like FAB, ENBD, DIB, etc. And previously also worked with HSBC, Barclays, Deutsche Bank and Merrill Lynch in London over the last many years, and with PRA and ECB as well, coordinating projects with them. So coming now to this timeline on the GBP and USD, as many of you would be aware, on GBP, back at the end of Q1 2021, we had a milestone to stop GBP LIBOR issuance and start SONIA issuance. So all new products should be on SONIA. Now I'm happy to say our clients have managed that timeline. They have already started issuing SONIA products. In Q3 2021, we had a timeline to complete active conversion of all legacy existing GBP LIBOR contracts to SONIA. Now, while not everyone has completed that, people started the process and this is ongoing now. Most of their portfolio is being converted and the part of the portfolio that will not transition over to SONIA will move on to synthetic LIBOR. We'll come to synthetic LIBOR later during the course of the presentation. Now, the key timeline on USD is that at the end of this year, the regulatory bodies have said after this year, no issuance of new dollar LIBOR products. So from January, new issuance should only be on SOFR. Some banks have already started issuing SOFR. The banks that I work with already have their legal systems ready, their legal documents and IT systems ready, at least in their main regions, to start issuing SOFR. They have done a couple of test products on SOFR, and for the smaller international locations, they should be ready by end of this year. The transitioning of USD LIBOR contracts, which will start in 2022 and continue, is still in progress. It is only at the end of June 2023 will the main tenors of LIBOR, USD LIBOR, have their cessation date. It's only for the minor tenors of 1 week and 2 months that the cessation date is end of this year. So moving on to the next slide, which are the key RFR conventions. Many of you might be aware of some of the conventions such as look back and observation shift. What happened is that because RFRs are fundamentally different to LIBOR, that they are based on actual transactions that have happened in the past rather than an estimate of the future rate. What happens is a few new conventions which did not exist in the LIBOR market have come into play. The key conventions are look back and observation shift. And what these do is that they give time at the end of the tenor period to complete the calculation of the interest rate owed during that period and send an invoice to the client so that the client then has time to pay back. Because if you use the current day rate at the end of the tenor period, you will know the last interest rate for the tenor period only at the end of the tenor period, and you will not have sufficient time. So people use the concept of look back. They look back at the rate 5 banking days earlier. 5 banking days is the convention, but most banks do have the flexibility to change the number of banking days to whether 2 or 3 or 4 or 0. And it's look back with no observation shift, which means that even if you look back 5 business days earlier, you will use the weight of the current business day and not of 5 business days earlier. So look back, 5 days look back with no observation shift is the market standard, but there's flexibility around it. There is also the credit adjustment spread. And that is a spread which is used to add to the margin so that the RFR contract is economically equivalent as close as possible to the previous LIBOR contract, because the RFR rates and the LIBOR rates are different, so you need to keep them similar. So the margin is kept the margin is kept the same, and a credit adjustment spread or CAS is added. And the standard convention in the market is to use the ISDA median spread, which was fixed the same day that FCA made the cessation announcements of 5th of March. It is to use the ISDA median spread for keeping that equivalence. I won't cover the other conventions now. It's too much detail, but we can always handle that in questions. So moving on to the next slide, which is NCCR and CCR. Now, NCCR and CCR are just two types of cumulative compounding of the interest rate. So because the interest rates are based, so for example, for a 3-month period, you look back and look at the interest rate for each day and average it across those 3 months to come at a particular, to come at the rate for that tenor period. The averaging that you use is compounding, and there are some different methods of compounding. The one recommended by Bank of England was the NCCR, which most banks have now implemented or are in the process of implementing. And it's not much of, there's not much difference in the end result from these different methods of compounding. It is just that the NCCR allows for better calculation during breakage of a loan during the period of the loan. So during a syndicate loan, if it breaks during the 3 months, if there's a transfer between two lender parties, the NCCR makes calculations easier. With that, moving on to the next section, which is transitioning of existing Libor products. And if you see the slide, the impact of the transition of the contract. What we have shown here that all the existing Libor contracts that are maturing before the cessation dates, most of the banks are not doing anything with them. They're allowing them to expire. It is only for the existing Libor contracts that are maturing after the cessation date that banks are following active transitioning. This transitioning is currently in progress for GBP Libor and other non-USD Libor contracts. It's not yet started actively on a large scale for USD Libor contracts. The market will start that in 2022. Moving on to the credit adjustment spread, we did touch upon this earlier in the conventions that what we are using here most commonly in the market is the ISDA median spread. The LMA does publicly post the loans that have transitioned so far, and you will see that almost all of them use the ISDA median spread. Now, there is an alternative to this, which is to use the forward-looking market spread, which is based on the basis swaps, but this is not, we have not seen used in the market that much, though it can be used, and finally it is dependent on your negotiations with the client. But you do see that happening sometimes in bilateral loans. That said, now the forward-looking market spread is coming closer and closer to the median spread. It was further off on the 5th of March when the cessation announcement was made, but now it's coming closer and closer. Moving on to the next slide, which is derivatives. Just briefly touching upon derivatives, most of the derivatives are using the ISDA fallback protocol, and most of the banks have adhered, around 15,000 plus back in January had adhered to the ISDA fallback protocol. It keeps growing. And what's happening on the ISDA fallback protocol is that we see the banks which have adhered to this don't have to do much because the ISDA covers for the fallbacks. So the moment the cessation date occurs, all derivatives automatically transition over to the fallback. And your new derivatives are also covered under ISDA. All cleared derivatives, LCH and CME will transition the Ibort rates to RFR a bit before the cessation date. So for GBP Libor, LCH is doing that on 17th of December weekend. And they haven't announced the date for USD Libor yet, but it will happen shortly before June 2023. Moving on to something that will interest most of the market, we are so far talking about in arrears rates. And now we are talking about term rates. So yes, RFRs are usually look back rates calculated by compounding them in arrears. But because of certain market requirements, term rates have been announced, though there is a restricted use on some of them. For example, on the term SONIA, which was announced last January in 2021, the Bank of England made it clear that you should not use it for more than 10% of the products, and they should not be used for loans or derivatives, but they recommended it for customers with low sophistication, those who could not do calculations. They also recommended it for trade finance and export finance and Islamic finance, though in Islamic finance, we have already seen the lead banks use in arrears rates and get approvals recently on in arrears rates. So just on the term SONIA, because Refinitiv was the who is present, who is running this live event, was what the Bank of England, one of Bank of England's chosen vendor for the term SONIA. We'll just show the next screen, which is actually from Refinitiv, and this kind of shows the GBP fallbacks and the USD fallbacks. Is there something you want to add on this, Vincent?
Well, thanks. Thanks, Kedar, and very briefly, yes, to your point, here you have a view on one of our pages on the Ibort app, which provides access to that kind of information, specifically to the fallback rate, which has been one of the most recurring questions we got, especially after March the 5th. And as we mentioned in the previous slides, Refinitiv is authorized distributor for ISDA fallback rates, and there are dedicated pages, and there is a dedicated app that we will discover also together with Alexander later on, the Ibort app, which provides full overview on all the rates and all the benchmarks and all the useful data, which is available to all of you navigating, to all of us navigating through this transition. Obviously, if I can refer to what has been our project when it comes to the Libor transition, we were and are committed to providing our customers with all the data and the analytics and the benchmarks required to adjust their operating models to go through the Ibor reform and the transitioning out of Libor. And we have committed to this statement, and this was an important project that we rolled out within our organization. And if I can summarize in those blocks the key areas that we have been covering, I would say that in blue you have the area of the data and the analytics. Sorry, in blue you have the data section, right, with access and providing access to market data, so the alternative risk reference rates, the term rates, but also the brokers data, which are incredibly important when it comes to the brokers providing packages and specific data on OISs, basis swaps, cross-currency basis swaps, and so on. As you can see here from the usual names in the market, but also reference data, right? Because it's important to have visibility on the fallback language availability and in specific pages to be aware of what has already transitioned or not, and then we will deep dive a little bit on this with Alexander as well. Benchmark wise, obviously, as Kedar mentioned before, Refinitiv term SONIA is live, right? It has been launched, is in production, is a benchmark that we administer through a specific company which is regulated by BMR and all the relevant regulations for benchmarks. And we also introduced the Tokyo swap rates, an adjusted one for the swaps mentioning TONA, basically. And we are obviously open to cover other term structures. We are waiting, further decisions taken for the European working group on Esther, which is one of the term rates missing, if you want, other than Switzerland, where there is no and there will be no term rate by decision. Obviously, as we mentioned, fallback rates. Refinitiv is the authorized distributor for fallbacks, as we mentioned before, but also, and we will touch on this later on, Refinitiv has been selected by the ARC as the sole producer of the USD Ibort cash fallback rate. So moving attention to cash on and beside the derivatives, which are covered by the ISDA fallback rates when it comes to the counterparties who signed the protocol. And obviously, a lot of investment has been done on our side to make sure all the search and the monitoring capabilities can be pursued in an efficient way. And you will hear from Alexander as well on the big investments we have done and improvements on zero coupon curves calculated on risk-free rates and all the calculators that have been updated. But maybe, Alexander, you can add something in here as a general comment.
Sure. Hi everyone. So I'm Alex Ardouin, looking after the fixed income desktop business globally at Refinitiv, working closely with Vince. So yeah, we have, as Vince has just alluded to, we have made a lot of work to expose new market data and also new analytics tool, especially zero coupon basis free curves, because to price derivative, discount cash flows, and even compute forward cash flows, it's important to have the zero curve. So because there is liquidity in the OIS market, Sonia, and even so far, we've seen a surge in liquidity, and Kedar is going to talk about it. We can now derive accurate curves that can be used to calculate cash flows. So we have various tools that I will show you in a moment to price those instruments. Back to you, Vince.
Yeah, thanks a lot, Alexander. And indeed, if I can focus on the benchmarks and the fallback rates, which are here on the left of this slide, let's focus on those elements, because actually this is what the market is looking for, and it's also the main source of questions we are getting from market participants these days as we approach the deadline. Term SONIA, as we mentioned, Refinitiv publishes a term SONIA rate, leveraging his experience as an administrator of benchmarks. So we created it. It's available in 1 month, 3 months, and 6 months, and 12. Rates are published just before noon, so 11:50 GMT. And as we mentioned before, Refinitiv term SONIA is a ready available data benchmark for the market, subject to the UK benchmark regulation and administered by Refinitiv Benchmark Services Limited. And all the information on our benchmarks is, by the way, available, including the methodology and all the relevant white papers available in our pages. The other big investment we have done has been on swaps, right? For Tokyo swaps rates, we already produced a benchmark rate, which needed to be adjusted because of the JPY Libor component it was obviously including. So we introduced a new version of the Tokyo swap rate for swaps referencing TONA, which is available to the market, and soon we will introduce JPY Libor Tokyo swap rate fallbacks. So this was at the very heart of the questions that we got in the previous months from market participants, because this is needed, as well as we mentioned before, the USD Ibort cash fallbacks, which we launched, is available in prototype version. And what is important here is obviously we moved from, while there is the derivatives covering derivatives, here we're talking cash market. And considering the relevance of the cash USD market, that was a very important achievement to be recommended by the ARC, the Alternative Risk-Free Rate Committee in the US, as the unique sole benchmark administrator for the USD Ibort cash fallback rates, which are available in prototypes as of today. and soon, let's say in autumn 2021, should easily move into production so that you can use. And again, all the full list of the rigs and the methodology and the papers behind are available in our page. If you just type Refinitiv benchmark USD Ibor, you get access basically to to that page, and here you have also the links which will be available to you. And the other quick thing we did overall, and then I will hand over back to Kedar. At the very beginning, we had a lot of questions on what is available. How can we get an overview of what is available in your platform when it comes to, and in the market when it comes to this transition? So we introduced a very simple but powerful app, which is called Ibort application. So very easy to look for. And here you have access to all the relevant rates, the incumbents, the new ones, the upcoming news, but also the Excel calculator for the compound realized rate that Alexander will touch on later. The webinars, the broker data, all available with the ability to deep dive on specific jurisdiction, on specific currency pairs, and analyze and understand and deep dive what is available in terms of rates for the Libor transition. So an easy way to an entry point for all the details that can help you in the workflow when navigating through the adoption of a new rate into your systems. And yeah, maybe Alexander, if you want to add something on the risk-free rate zero curves quickly. I think
yes, sure. So this is closely linked to the content we are receiving from interdealer brokers, but also receiving from a TradeWeb, which is a partner to us, part of the LSEG group, where the leading e-trading platform for fixed income, where we are receiving traded OIS quotes, especially here focusing on SOFR and SONIA, which allow to build zero coupon curves. And again, to stress the importance of the curves on the rates market in general, it is used everywhere, used to discount cash flows. It is used to project cash flows for for swaps, and even could be used for FRNs. So we have a set of curves that you can use. So obviously we are currently in an environment of a multi-rate environment where you still have the Libor curves. So if you look at the screen here on the right, you've got for Libor curve 1 month, 3 months, 6 months, and 1 year curve available. And we have added alternative risk-free rate curves, mostly based on OIS, but we also see some activities and liquidity on futures, which means that they can be used as well to build a near end of the curve.
Yeah, thanks a lot, Alex. And with that in mind, I would like to hand over back to Kedar.
Sure, thanks. Now looking at the term SOFR, we previously touched briefly on term SONIA. On term SOFR itself, the ARC, which is the US body, recommended it to start using term SOFR back in August. It's for 4 tenors, 1 month, 3 months, 6 month, 1 year. And they recommended it, as you can see in the first table, for fallbacks for existing loans converting to SOFR. They recommended it for all products apart from derivatives. Derivatives will continue to be in arrears. This is alongside in arrears rates. So for those products such as business loans, syndicated loans, FRNs, trade, you could use either or. On trade finance, we mostly see people using term SONIA and term SOFR for trade finance discounting in the market. And for new issuance, they recommended it similarly for most products apart from derivatives. They did not recommend it for FRNs for new issuance. Now, keep in mind that this is a recommendation. They would still like to see a greater use of the compounding in arrears rates or simple in arrears rates averaging. And the reason is that the term SOFR, for term SOFR to be robust, your in arrears SOFR has to be robust. You cannot have one without the other. You cannot have term SOFR without having a good liquid market in SOFR in arrears. And We have not yet seen the market start using term SOFR for other products and loans as much. We are observing what change happens as things go along. So I think we'll know more in the next quarter. Now coming to briefly to market updates, what are the changes we have seen recently in the markets? So back in July, a SOFR first initiative was started, where if a trader asks the broker for a USD price in the interdealer swap market, the broker has to respond with a SOFR quote first. This was first started for normal interest rate swaps. On 21st September, they also started it for cross currency swaps, and 21st October, they switched off the Libor on the interdealer screens, and it's only SOFR that's being quoted. Libor is available only for informational purposes. Now, this kind of activity, which was supported by all the regulators, has drastically increased the SOFR liquidity in the market. As you can see from the graph, the SOFR risk has shot up. And if you see the comments that I have put in the bottommost table to the right, you will see that GBP saw the largest percentage of RFR linked interest rate derivatives activity. That's around 64.8%. And that is obvious because GBP, the cessation date is this December. So that's why it's gone up. Same with Japanese is 55% now of the risk. But for SOFR, which was initially 7.4% before this SOFR first initiative, it's now gone up to 15% in September and should have gone up in October. We are still waiting for the results to be published, which will happen now soon. So it keeps going up. 95% of cross currency swaps are now trading RFR versus RFR and not RFR versus Libor. Interdealer swap market itself is now 78% SOFR based. So that's very positive for increasing SOFR liquidity. Moving on to the next slide, you will find that all the European regulators suggested in June to cease Libor settings. And we spoke about term rates, and Bloomberg introduced a credit term rate because RFR as such does not have a built-in credit or liquidity premium like Libor does. So they introduced a credit term rate, but the SEC has advised against using it. The SEC suggested that keep the usage to term SOFR. And we already spoke about LCH doing the clearing for all the exchange cleared Libor swaps. They will convert them to SONIA swaps this December. They have already converted them on the European currencies, and for USD they will do it shortly before the cessation date of June 2023. And very importantly, ARC selected Refinitiv as the vendor to publish ARC suggested spread adjustments and fallback rates. So now all market participants, not only the banks who have access to Refinitiv, can view what the ISDA median spreads or the credit adjustment spreads are for dollars. They can also view what the rate should be used for fallback depending on various look back and observation shift or no shift conventions. This is something Vince also mentioned earlier during the presentation. And now for those of you who are on GBP Libor or Japanese Libor and transitioning over, the FCA did announce an important update, which the consultation results are due out now, but we are expecting this, which is they have announced the continuation with synthetic Libor. So the synthetic Libor is nothing apart from the term SONIA plus the ISDA median spread. It will be published from Jan 4, 2022 on the screens instead of the Libor. It's not permitted for clear derivatives, but contracts which haven't transitioned instead of the Libor rate, they will use the synthetic Libor rate. and this will just automatically happen from 4th of Jan. However, a very important thing is that FCA doesn't mean that market participants shouldn't just sit back without trying not to transition and default over to synthetic Libor. They want to see market participants attempt to transition and reduce their risk, and then if they fail to do so, to use synthetic Libor. And for our clients, we do make sure that they audit their process to transition so that we can evidence the fact that they have made their best efforts to transition, and only where they have been unable to because the clients haven't responded or something like that, they use synthetic Libor. On the next slide, I just show some of the SOFR FRNs that were published by some leading banks like Goldman Sachs and European Investment Bank, Morgan Stanley. You will find that they have all used different, slightly different conventions on look back, on averaging, and lockouts. But this is just for your, this is just as a sample we showed to show that things can work slightly differently and you need to be flexible around these conventions. Moving on to the next slide, that's just Refinitive fallback provisions. I don't know, Vince, if you want to add something here. Or it's just, or I can move to that.
Yes, that's something I'm going to show in the little demo I run afterwards. Fine. But just to say, for FRNs, you have some information on the fallback provisions when they are available in our database of records for terms and conditions.
Okay. Just a couple of things on the next few slides. One, we have just put forward the accounting implications. We are not going to go into details here, but obviously Ernst Young being an accounting firm also, we have a very strong accounting practice to help clients through the accounting implications of phase 1, phase 2, and economic equivalence, and how to do the reporting. On the slide, key considerations for Ibort transition. That's just the way we manage the programs with our clients so that they touch upon various aspects of the Ibort transition. So we just put some here to show that you have to think through all these aspects to make sure that you have touched upon all the areas of your firm. And finally, in the appendix, we have put in some information for you. We leave that for your perusal at a later time. So Vince, would you like to take over just for the demo?
Yeah, I will hand over to Alex for the demo section, and yeah, I will stop sharing now. Fantastic. Yeah. Alex, if you can unmute yourself, we can see your. Oop.
5 minutes. Yeah, sorry, I can't seem to unmute when I'm sharing. So unshared, reshared, and unmute. Yeah, so as a wrap up of the session, I think it's good for you to have an overview of how everything that Kedar and Vince have talked about realize into our Refinitive icon desktop. So that's the main desktop solutions we are providing to the market. But bear in mind that anything you can see here, so if I'm taking here the benchmark SOFR, there is an instrument code that can be used outside the desktop. So if you want to consume it via feed, you can also do that. So if I take the example of SOFR, this is the benchmark. So the compounding, so the daily overnight rates that is used for compounding calculations. So you see the rate here. We also have term SOFR for 1 month, 3 months, 6 months, and 1 year. We have the compounded average. And then if you scroll down, so this is the Ibort I forgot to mention, but if we scroll down, you see the wealth of content we are getting from interdealer brokers from OIS. So you have two OIS markets currently in the US, so the SOFR and the Fed funds plus the Libor. So you've got the SOFR OIS, but then you've got the basis markets that have been created by the transitions where people can exchange SOFR against 3 months Libor or SOFR against Fed funds. And then we start seeing some liquidity on caps, floors, and swaptions, even if it's much, much lower than OIS. So we have caps and floors volatilities, especially for people creating product where there is a floor at 0. And ultimately, we've got also these that fallback that have been discussed by Kedar and Vince. So, it's very, very complete. If I move to Sonia, we would have the same kind of information. So we'll have the fixings, we'll have the term rates, etc. So let me not spend too much time on Sonia, the same kind of information. Then we have the bricks. We have also created an Excel spreadsheet here that I'm showing that lists all the market data you can get for each of the currencies, for the curves. It's very, very complete. So if you want to access our data, not from the desktop, but again, outside using feeds, you can use that data catalog that we have created in order to find the various instrument codes available from Refinitiv. So this is the Sonia. So you see the same type of rates, term rates, fixings, broker content, fallback. It's all there. Now, if you want to search for something a bit more specific, we have an advanced search component called Search OTC Interest Rate Derivatives. If you search for SOFR, you'll see that actually in terms of instrument type, there are quite active instrument type, 62 different instrument type with overnight index swaps, basis swaps, FRAs, and as Kedar alluded to, cross-currency swap, which is the big topic at the moment. So for instance, exchanging SORA against SOFR, if I pick up one randomly, but you would have the same for Esther against SOFR, Sonia against SOFR. So whenever someone now is doing cross-currency basis swaps, you have the option to exchange against SOFR and against Libor. What we see is that for anything short-term, that would be SOFR short-term and long-term, and Libor is only short-term now, given the transition date set to June 2023. You remember what we've discussed about FRNs. FRNs used to pay Libor coupons. So what happened to those existing Libor FRNs? Well, what we've done is that we have added two main fields into the database of record, saying, has the index been transitioned, yes or no? So I have a FRN, I have an issuer, let's say a big corporate issuing FRNs, I need to transition to give indication what will be the coupon like after the transition. We have information of index transition and fallback language exists. So you see that, and this number is increasing every week. We have about 22,000 bonds for which we know that they have been transitioned and there is a fallback language. How does it look like? Let me take the example of a Bank of Montreal GBP floating rate notes that used to pay, still paying by the way, still paying GBP Libor 3 months, but the issuer, the Bank of Montreal, provided the replacement rate, which is the Sonia weighted average plus a spread. So that's really a useful information here. On the cash market, another way to know what the market is doing and what is the adoption is to have a look to the new issues. So here we have an app called FINIM, Fixed Income New Issue Monitor, where you can check what have been in the last 30 days the FRN issued on SOFR. And it's interesting to see here, to look at the term to maturity, where in the list you'll find some long-dated FRNs like this one, like this one of 50 years from Jeffries, like, a lot of them, and they also issue amounts. So 82 FRNs issued on SOFR with quite mix of maturities between short, medium to long term. Now, if we do the same exercise, the same applications in ICON, but on USD LIBOR, USD 3 months contract, what you see here is only 12. We had 82 and so forth, and most of them, almost all of them, except this one from Sumitomo, are maturing before the deadline of LIBOR, which would be June 2023. So there are only 2 exceptions here. So you see that the cash market is really transitioning. Coming back to the rates derivatives market, one of the challenges is to be able to price those new instruments, the OIS in arrears, a 5-year OIS, SONIA, where you pay fixed and you receive float quarterly, fixings in arrears, overnight SONIA. So the SONIA here gets compounded over a 3 months period to pay the coupon, and you can recalculate the fixed rates. Why is that possible? It's again coming back to that topic of curves. We have a set of curves. Sorry, it's not this one. It is this one. So we have a set of curves to price any kind of instruments that are based on alternative risk-free rates. We have created those curves, and you can find the constituents there. You see that the constituents are coming from OIS quoted by TradeWeb with a very tight bid-ask spread. So this is a very good rate to use as an input of the curves, because it means you can have a very tight curve, bid and ask, and you can calculate your curve and reuse it for discounting purposes, fair value calculations, whatever you need in order to recalculate your positions on rate derivatives. And you can also use it to calculate cross-currency basis swaps when you do this on 2 legs. So we also have similar content on USD, where USD is even more complex because you have the SOFR curves, you have the Fed fund curves, and you still have the LIBOR curve. So you see the set of curves we have on USD is quite impressive now, with that environments where you have like three different references, 2 on the overnight, and still the LIBOR for a quite long amount of time. And again, we would have the same for EUR, where you have Ionia, OIS, where you have Euribors, and you have Esther, the new reference there. So that's really a lot of new market data, but using our solutions, you can find them easily using the Ibort app and using the tools I've just demoed. So we are, if you need to deep dive, if you have any questions, you can ask us. What is also important, to Kadar's point on references, is very simply to be able to calculate an interest flow on a period. Let's say you have a loans or you have a coupon payment to make on SONIA between the 9th of October, 11th of November, and a notional of 1 million. Maybe the bank quoted you a spread of 0.5. Then you can recalculate using the 5 days lag. And you can change, if it's not 5 days, if it's 4 days, you can change this and recalculate, including a backward shift or without the backward shift, the realized rates, and you also have your average rates on that. So we provide this type of calculation tools through Excel, but also through an API. We have had several clients consuming our calculation tools and through API. So that's really interesting, because you are not stuck to Excel. You can include it in your own calculation tools. So we'll pause there because we want to have about 10 minutes for some questions. So now floor is yours. Feel free to ask questions if you have. I will stop sharing my screen, and feel free to jump in for questions.
Thanks, Alex. And just before we move into questions, I was wondering if each of the speakers could maybe give like a quick 30-second summary of what you think are the most important points or the most important takeaways from today's event, please.
So maybe I can start. I think, yeah, what's really important, it all depends on the rates you are exposed to. So if you are exposed to SOFR USD, you have a bit of time, but still now it's time to identify your exposure. If you are exposed to SONIA, to GBP SONIA, CHF SARON, or GPY tenor, you should implement the transition now and switch to alternative risk-free rates or term rates, and also identify where you need to apply the ISDA fallbacks and derivatives and the fallback for cash.
Thanks, Alex.
Yeah, my 30 seconds would be, as we all knew, right, this transition brings in financial risks and non-financial risks to be managed, right? So I would like to focus a little bit on the non-financial side, right? So when it comes to technological and operational readiness, that is an important step, and I think we all want to achieve that before mid-December, so that systems, treasury management system, risk management system can work, right, and ready to digest the new rates. And then the other non-financial risk component is on communication and conduct risk. So making sure that, as an example, banks have correctly communicated to their customers, right, informing about the change so that a new rate doesn't come as a surprise or seen as a detrimental on their side. So all of this requires governance, requires communication to be done in a proper way.
Thanks, Vincenzo.
It's Kedar. So I think the most important thing that will now happen is, how does term SOFR move? How does synthetic Libor? How much of synthetic Libor gets used, and how do firms evidence that? And finally, when does the market start transitioning the existing dollar Libor contracts? So I think for non-dollar Libor contracts, most of the things will be closed by this year, so that's pretty clear. But these are the uncertain and things that we are watching that have to be observed over the next quarter. That's the most important.
Understood. So now moving into Q&A. So for our first question, I understand we haven't seen much use of term SOFR just yet in the market, but what have you seen, and how are people handling the existing contracts?
So what's happening with term SOFR is, just like with term SONIA, it's predominantly being used for trade finance discounting. It's also being used in some cases in quite a few cases for overdrafts. Where we haven't seen much use of term SOFR, though it's permitted yet, is on loans, so actual bilateral or syndicate loans. There have been some instances, but not very liquid, and I think the whole market is observing to see who starts using term SOFR more, because they have all prepared for in arrears, and if it picks up pace, then obviously it will become very easy for other people, but currently in arrears seems to be the norm, and that's where what people are using.
Understood. What will happen to new drawdowns on existing USD contracts?
Yeah, good question. So what the regulators have said is that they would not like new issuances. Well, they have said no issuances on dollars from start of January, and they have clearly defined new drawdowns on existing contracts as new issuance. However, some of the market might, where dollar is available, even though dollar Libor starts becoming less liquid, if it is available, and if they are planning the transition of that contract very early in 2022, they might still do a dollar Libor issuance on existing contracts early next year, before they transition it over to SOFR. So obviously everyone understands it does take time when a client approaches you for a new drawdown, to get him or her to get that corporate to sign over onto the new terms and conditions for SOFR. So that time they might do a dollar Libor contract if there is still liquidity in the market. The liquidity should drop after January. So we have to observe.
Can you please confirm how long synthetic LIBOR rates will be available for GBP and JPY, please?
Yeah, maybe I can quickly comment on that. The indication which is available through the consultation paper is for 1 year, so at least until the end of 2022. And I think this is a key point because, as Kedar and I think also Alexander mentioned before, this is not an extension, right? It's just a solution, a temporary solution for GBP and JPY to allow the handling of the tough legacy contracts, right? So it's just a temporary solution. So we will hear more by the end of 2022 from the FCA, and it's just for GBP and JPY. The consultation paper explicitly says that it doesn't cover USD.
And CHF doesn't cover CHF.
Yeah.
And for us, it means that our Ibor pages will be maintained and have the RIC updating after the 31st of this year onwards until there is no more synthetic LIBOR.
Indeed.
Does anyone have a view on credit sensitive rates?
Well, it's an interesting topic. I think Kedar mentioned before, right? Obviously, the new rates do not incorporate a credit liquidity premium, so this has generated some interest from the market into the approach of credit sensitive rates. As we already mentioned before, there is indeed some resistance offered by the authorities, which is available, it's public information, so the indication is not to use. On our side, I would say in full openness, as we are open as a business at Refinitiv, we carry those rates, those ones available in the market. But again, the current view is that there is no endorsement, if you want, from authorities. So we leave it to the market actually to understand how to deal with this component.
Understood. Any other comments or any other questions rather? Okay, well, I guess we'll wrap it up here. So I just want to thank all the speakers, Alex and Vincenzo, and then a special thanks to Kedar for joining us from Ernst Young. And then finally, thank you to Danny for organizing, and thank you to Robin for all your support. Have a great day, everyone.
Thank you. Thanks.
Thank you very much.
Thank you, everyone. Bye-bye.
Bye.